Greece has gotten itself into a long-term difficult situation by spending more than they take in taxes, and they've done this for a long time. When they entered the European Union, their debt to GDP ratio was over 100%, and it was supposed to be 65% or something like that. What they've done in the past, when they had their own central bank, is they could just buy the bonds with money they printed. It would, of course, cause inflation, but bondholders kept coming back. Now they're in the European Central Bank, and the ECB won't buy those bonds, so the only way that Greece can pay off the debt that they have is to have tax revenue sufficient to cover the interest rate and pay back those bonds, and they don't. So they talked about the fact that they needed to have austerity, which was a combination of increases in taxes and cutbacks in spending. And the Greeks took that very well. Oh, wait, they didn't. They rioted in the streets. And then, in a sense, they rioted at the ballot box over the weekend by deciding that they don't want the austerity measures. And you think to yourself, well, what are they thinking? But of course, on an individual level, they've looked forward to a retirement at a certain age with the promise that was made by the government. And on an individual level, they're thinking, I have this coming to me. And somebody's trying to take it away, and I'm going to vote that person out. Long term, it's just not going to work for them. I would say that long term, what they're going to have to do is drop out of the euro, go back to the drachma. The Greek central bank will then buy up all those bonds, print money, cause inflation. The value of the drachma will decline over time. They'll go through some difficult situations, and 10 years from today, they'll be back where they were before. A high spending, low taxation, high inflation economy.